Right, but that
So
treasury, the interest is not transferable, so they take the interest and they buy gold with it, which pushes gold up, devalues the dollar, which is exactly what they want. And if the Fed wants, the government wants, if they were going to back the back end of the treasury market with gold, well, you want it to go way higher, so that when you sell a long bond with zero coupon, meaning no upfront borrowing costs, but redeemable in gold in 20 years or whatever, you got a lot of runway to let gold go higher, 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 and the dollar go lower, 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 lower. When gold goes higher, it devalues everything, the dollar included, as it is the one neutral reserve asset to which you measure everything against, not a basket of crap currencies that continually devalue against the dollar. So in February and March, over 2 months in a row, China imported the most silver ever in the history of the country. Since they've been keeping records in February and March, they rose 78% as the price was getting its teeth kicked in. Before I even touch on 2026, we can look at the gold imports into the United States, starting in 2025. The gold imports they would be on even months. So February, April, June, these are the delivery months for gold. The odd months are for silver. They both deliver in December. You go back to 2025, every single COMEX gold contract month in 2025 set all-time delivery records. We've seen going on 19 straight months of COMEX deliveries. Now, when you deliver to COMEX, doesn't mean it leaves COMEX. That's an offload. And there's been a lot. February in silver was a lot, but let's finish talking about gold on COMEX. In February is a major delivery month for gold. 76,567 contracts were delivered. That's 7,656,700 ounces. That's a new all-time record. 35.2 billion in gold delivered in a single month. And when you put that in perspective, if you go back to 2015 to 2019, I started on Dunnigan Kaiser's show, Liberty and Finance, screaming in 2020. Every podcast, something's going on. This new group of reportables on the Commitment of Traders report that's never been there before. They call it the others. Whoever the hell the others are, subsequently they appear to be sovereign wealth funds. They're standing for delivery at a level no one's ever seen before, because typically 1% of contracts stand for delivery. But if we go back from 2015 to 2019, the U.S. average, or the COMEX average, only 139 tons delivered per year in deliveries. February 2026 alone was 238 tons. That's nearly double an entire year's average from just 6 years ago. When you talk about silver, February was a non-delivery month for silver, 26 million ounces delivered, but 39 million ounces were loaded out. In other words, they left COMEX. That's 2.7 million pounds of silver as the price got smashed. Now remember, same thing with gold. Who took the largest delivery in the history of the COMEX as the price got smashed? And so, great, 26 million ounces delivered of silver in February, 39 million ounces leave. It's never coming back. Would have to be drilled and assayed, and 2.7 million pounds. That's quite a few semi-truck loads. And where's it going? Who's running insurance? But that's on top of 9 straight years of central bank purchasing and repatriating. And, it's interesting. The countries like, the central banks, the ones that are printing the money, are loading up on the things that they can't print. I find it kind of ironic. But yeah, I mean, in both gold and silver, to your point, not only has the COMEX seen that, but you take a look at what's happening in China. It's off the chart. Again, in February and March, over 2 months in a row, China imported the most silver ever in the history of the country. Since they've been keeping records in February and March, they rose 78%.
Governments worldwide are trading paper wealth for hard assets. Countries like China and Poland are dramatically expanding their gold purchases due to declining trust in paper money. Meanwhile, Asian markets are aggressively buying massive quantities of physical silver, slowly draining global supplies without causing immediate panic.
Month over month to a record 836 tons in March. Now, that's 170+% above the seasonal average year over year. But their imports for the year, for the first 90 days, for the first quarter of this year, are at 1,626 tons, the highest on record. as the price was getting its teeth kicked in. 1,626 tons times 32,150.7. That is the amount of metal in a metric ton, troy ounces, is 52,276,939 troy ounces, $4 billion worth of silver imports in just the first 90 days of the year as the price was getting slammed. So you look at, and by the way, same thing with gold. They've done 3 consecutive monthly increases, 17 consecutive monthly purchases. They've imported 365 metric tons in the first 90 days. That's 11,735,055 troy ounces. That's $54 billion in the first 90 days alone. So whether it's China or it's COMEX or it's Poland or it's Kazakhstan, all of these countries are just loading up on it. And if you are a sophisticated trader, you trade them 10 million ounces of silver at a $9 premium above the Western price. That's $90 million. That's not a bad day. And there are people who say, well, what about the VAT tax? Well, the VAT tax is paid by the recipient when the metal leaves the Shanghai exchange. It's not paid by the shipper. There are things called exchange for physical where you can buy a COMEX contract and deliver it to Brinks, Hong Kong, where a truck picks it up and brings it to Shanghai. I mean, there's a lot of metal going and being delivered to China by any way they can get it, whether it be by just standing for delivery on contracts across the globe, buying up anything they can across the globe, or in this case, enticing arbitrage, which normally should have been gone a long time ago. It's been going on for the better part of a year because they're just taking that trade imbalance and all the dollars they're choking on and buying real things with it, even if they're paying more than the West will sell it for over here.
Is there any indication, Andy, that the United States is buying gold?
Well, who stood for delivery? Who's standing for delivery for all this amount? My feeling is that they are. The Exchange Stabilization Fund would not need to announce this to Congress if it was for national security, and they could deem that it is. I also think that one way or the other, the gold that Tether is accumulating will end up at the U.S. Treasury. I think that is a deal that they struck. Now, I have no proof of that, but when you put Bo Hines, who was Trump's crypto czar and confidant, into the CEO role of USA Tether, which is already Genius Act compliant, and Tether has bought more gold right now, literally, than any central bank on the planet, with the exception of like Poland, Kazakhstan, and China, this year, and is up to $20 billion worth of gold holdings. That's no small feat. This is something that, they purchased 5 tons of gold here in the first quarter alone. That's central bank size. They're up to over 132 tons of gold. It's like 20 billion. That devalues the dollar, especially if it were to end up in the U.S. Treasury hands and get paid money for it. That would certainly fall in line with the Judy Shelton theory. I do believe they are. I think Secretary Bessent knows what is going on as it pertains to maybe more so than most people. And he's a gold bug. He understands gold more than most people. It was his largest holding when he ran a hedge fund. Yeah, I do think they are. There's no proof, but I do think they are. Don't they just throw all the money at it and drain the thing just like that? Because if they did, the system would blow up. It would be force majeure. It would halt. It would stop to protect itself. At least the exchange at COMEX would. So instead, these players are slowly draining the exchanges little by little, pulling it off little by little, not only just the eligible or registered category, but eligible metal. A couple weeks ago, Friday, over 2 million ounces left the eligible category. I think it boils down to trust or lack thereof. An exchange that's suffered 4 glitches since Thanksgiving, 2 to the up, 2 to the down. That should never happen. 2, when silver and gold are both moving up, they get glitched, overheating servers when these servers have triple redundancy. And of the 1,000 commodities traded, only gold and silver got overheated. And for 11 hours, it shuts down. And when it opens up, it starts to watershed. And the same thing the second time, similar. It was a glitch. They didn't say what caused it, but then twice to the downside where the circuit breakers didn't work, supposedly. So that's transitioning, I think, a whole bunch of people into a new thinking that the COMEX is a rigged system. And maybe you see that by the record low open interest right now, as many of the players just don't want to play in that arena anymore. And it's important to note that the drawdown that we saw, the BIS called structural, not fundamental. That largely it had to do with raising margins 300% into the first couple of weeks of January, where the ETFs have to rebalance. Those 2 weeks are notorious for volatility in commodity-backed ETFs, as their prospectuses mandate repositioning, rebalancing as to the directive of the prospectus. So you get selling by the ETFs to rebalance on top of massive margin hikes by 300% that people just sell because they can't maintain the margin, which is money just sitting in a collateral account where it's gone up so much, it's insane, that it just begets more selling, which begets more selling, and the price collapsed. And as that happened, well, you have the most sophisticated traders in the United States, the Central Bank of China, same time, we don't use margins, so we'll just take record deliveries. Thank you very much.
Digital finance companies are accumulating enormous reserves of U.S. treasuries and gold. Analysts speculate this could support a future financial system where digital dollars are backed by precious metals. A weaker dollar paired with higher gold prices could easily reduce government debt, but it also increases centralized financial control.
Right, but that treasury, the interest is not transferable, so they take the interest and they buy gold with it, which pushes gold up, devalues the dollar, which is exactly what they want. And if the Fed wants, the government wants, if they were going to back the back end of the treasury market with gold, well, you want it to go way higher, so that when you sell a long bond with zero coupon, meaning no upfront borrowing costs, but redeemable in gold in 20 years or whatever, you got a lot of runway to let gold go higher, 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 and the dollar go lower, 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 lower. When gold goes higher, it devalues everything, the dollar included, as it is the one neutral reserve asset to which you measure everything against, not a basket of crap currencies that continually devalue against the dollar. So by devaluing the dollar, you can sell manufacturing, you can pay down the debt. By having the zero coupon bonds, you can bring back manufacturing at no upfront borrow cost and redeem it in gold on a zero coupon bond down the road when it matures, which would then allow the every time money moves, anytime, whether it's a pack of cigarettes or a new house, it's backed by stablecoin, which is backed by treasuries. And trades like that settles right away. With those short-term treasuries, 90-day or less, will be synthetic demand for the treasury, but that interest, according to the Clarity Act, to your point, is not, you can't pass that out to the holder of the stablecoin. It's not transferable. So they take that interest and buy gold. U.S. Treasury, I mean, why else would Bo Hines be there if not to work something like this? He was Trump's confidant, cryptos are. It's like putting Stephen Miran, who wrote the Mar-a-Lago Accord, at the Fed. I mean, there's something bigger there than just coincidence. And if he said, look, you're going to do this, you're going to help the country, you're going to devalue the dollar, you're going to back the back end of the bond market, help us do that with rising gold. The devalued dollar allows us to bring back manufacturing and actually sell it and also work down the debt. Otherwise, what do? In essence, by doing this, they're defaulting softly on the reserve status to incentivize and promote credibility in the bond market, and to devalue the dollar to pay down what is a debt that is unattainable the way that we have it right now. There are three ways to pay it down. You can inflate, default, or produce your way out of it. Well, we don't have manufacturing, and that's a bigger problem in and of itself. So that is why Triffin's dilemma has been spoken about in such a manner by Vice President Vance, that can't afford it anymore, and Jared Bernstein, the previous economic advisor for the U.S. government for Biden, who wrote a report, Dethrone King Dollar, that speaks to this. So I think they want it to go higher. I really do. And so, yes, I do think they are accumulating it. And if they do it through a company like Tether, it makes it much easier for them to be much more stealth about it, if you will, in terms of who's accumulating it, et cetera. So it's less reporting, I think. So yeah, I'd be shocked if they're not.
Major financial institutions are finally changing their tune on gold. Giants like BlackRock and Morgan Stanley now openly recommend hard assets to protect against inflation and weakening bonds. This massive shift proves that institutional money is actively preparing for a much more volatile economic environment ahead.
Who makes the rules,
everything.
the golden art of negotiating. Yeah, I mean, you're right. And that's usually what they do. They drop crumbs. Another way of saying it is, I work with, I have a very good friend of mine who is a broker at Morgan Stanley, Forbes top 40 list, manages $4 billion. He's huge. He wouldn't know gold coin if it fell on his foot. And I say to him all the time, Russell, do you understand that your chief investment officer, CIO of Morgan Stanley, said sell half of your bonds and put that 20% into gold? And he kind of chuckles it off. But the point is, this is one of the biggest money managers that Morgan Stanley has in the country and doesn't talk about it. The point is, when their chief investment officer says it, or Michael Hartnett from Bank of America says it, or Jeffrey Gundlach says it, the Bond King, or now BlackRock is saying it, they're speaking to the institutional traders. And when it all goes haywire and gold does go to the moon and everyone's pissed off, why didn't you say anything? Well, we did. Didn't you see it? The point is, they're only speaking to the people way up here, the ones that are standing for delivery and stuff, not to even the sophisticated money managers who wouldn't know gold if it fell on their toe. And that's the thing. But at least the drop crumbs, if you search high and low, you'll see it. You won't hear it anywhere. Your investment advisor won't tell you about it, even if it's a Morgan Stanley. The chief analyst for Bank of America says put 25% of your assets in there. His newsletter is thousands of dollars, goes to the institutional traders, not to the Bank of America clients. And so what we told you, maybe you weren't listening. Maybe you should research more. That gives them the plausible deniability. But I do think that this is coming. I think we are transitioning from a world where gold was held down forever to one where gold will be set free for opposite reasons, but valid nonetheless. But how about former Treasury Secretary Paulson coming out and saying we need to make a break the glass type of procedure to protect for the imminent collapse of U.S. Treasuries, is more or less what he said. This is Hank Paulson saying the Treasury market has lost demand and we need to figure something out because when it collapses, it'll be very violent.